Despite the fact that the 30-year fixed mortgage rate may be falling, a real estate investor warns that the market is still crafting a perfect storm for clients, particularly single and multifamily homeowners. Patrick Carroll, the founder and CEO of Carroll, remarked on Mornings with Maria that we are witnessing a supply-demand imbalance, and now they have a lack of buyers because of mortgage rates, Carroll mentioned. Many people are debating if a housing bubble is likely to emerge, as more data points to the property market improving. Will there be a market crash or, at the very least, deflation anytime soon? This video is for you if you want to learn more about housing markets experts' predictions. Before we go on, make sure to subscribe to our channel so you receive more of our interesting videos. In a blog post published on March 29th, the Federal Reserve Bank of Dallas found indicators of a brewing US housing bubble. According to the report, while rapid increases in home prices do not necessarily indicate a bubble, other important factors to consider include changes in disposable income, the cost of credit and access to it, supply shortages, and rising labour and raw construction input costs, to name a few economic explanations for prolonged real house price advantages. The Dallas Fed research stated that when there is widespread belief that today's robust price increases will continue, the housing market becomes unhinged from these realities. If a large number of buyers believe this, transactions prompted by a fear of losing out may raise prices and generate prospects for huge rises in property values. Despite the fact that the researchers referred to the current housing market as abnormal, they concluded that there is no expectation that the consequences of a housing correction will be as severe as the 2007 to 2009 crisis. If you were hoping to find a house at a lesser price during a big slump, think again. For a variety of reasons, most real estate specialists believe the market will remain strong for some time. Here's why. Housing demand from Generation Z and Millennials is booming. There are 166 million Americans, or half the country's population, who are millennial aged or younger as of July 2019, and therefore there are loads of potential buyers. This is critical because according to National Association of Realtors data, first-time home buyers make for the biggest percentage, 31%, of people who purchase residences. According to Polina Ryshakov, Senior Director of Research and Head Economist at Sunday, a real estate marketplace for distressed houses, there won't be a slowdown since there hasn't been much growth in house inventory over the last 10 years. Gen Z will turn 30 and will be better financially equipped to become homeowners than millennials were at their age. While supply will tend to fall behind demand, housing demand will be at least as robust. The supply is insufficient to meet the demand. According to Rick Schager, Executive Vice President of Reality Track, the fundamental cause of the significant rise in house prices is a mismatch between supply and demand. Furthermore, it will take home builders at least a few years to add enough new supply to stabilize the market after not constructing nearly enough houses during the preceding 10 years. According to Odetta Kushi, Deputy Chief Economist at First American Financial Corp, eliminating the housing stock debt we have accumulated would take time. Even if house prices decreased from their peak pace of growth in 2021, the imbalance will continue to push them upward. Fewer people are defaulting on their mortgages. Since the 2008 housing catastrophe, there have been lessons learnt and new rules established. But one difference between today's housing markets and previous ones is that the lending standards are much more severe. In essence, this means that mortgage applicants are now less likely to fail than those who applied before the crisis. Prior to the housing crisis, it was common for lenders to make so-called no-doc loans, which did not require applicants to provide evidence of income. Furthermore, many government-backed loans have eligibility requirements, such as a minimum credit score and down payment. Furthermore, regulators insist that lenders, among other things, evaluate a borrower's ability to repay the loan. Warning signs that the housing market is about to become inflated. Many analysts previously referred to a strengthening economy as beginning to display indications of a recession. As inflation began to creep up and consumer prices began to rise last year, warning bells began to sound. In response to rising inflation, the Federal Reserve raised its federal funds rate in May 2022, the highest hike in 22 years, foreshadowing the risk of a slump. Higher interest rates may lead to less consumer expenditure. Energy prices, which were already rising, are expected to rise higher now that Russia's oil has been blacklisted by the US and the EU as a punishment of its invasion of Ukraine. Soaring energy costs will fuel the fires of inflation even more, and when paired with increasing lending rates, this might contribute to consumers cutting down on their spending. This suggests that consumers may grow less interested in purchasing a home. According to the most recent Consumer Sentiment Index from the University of Michigan, consumer confidence plummeted to a 10-year low in March 2022. In comparison to March 2021, the index fell by 30% to 59.4. Participants in the poll were concerned about growing inflation, steep rises in oil costs, and the impact of Russia's invasion of Ukraine on the US economy. According to Selma Hepp, Deputy Chief Economist at CoreLogic, geopolitical difficulties appear to be the wild card, with substantial ramifications for inflation, which is expected to last longer than previously assumed. Buyers will likely confront challenging housing conditions in the near future, as predictions imply that house prices will continue to grow and new home supply will lag. For some buyers, this means avoiding huge cities in favour of more affordable metro regions. Others will have to give up room or other amenities or stretch their budget. If housing prices and equity continue to rise, purchasing a home today might result in future financial savings, even if it means foregoing other investments. If home values suddenly decline, buyers may be compelled to stay in their homes until the market recovers, or sell and lose millions if their mortgages are underwater. Although housing experts consider this circumstance to be unusual, it should be taken into account. This is important when buyers are driven into bidding wars or wind up paying more than the assessed worth of their house. While this technique is acceptable in some instances, it is critical to examine if the property, area, and amount of time you wish to commit are valuable in the long run. Did you find this video interesting? If so, don't forget to hit the like button, subscribe to the channel, and share your thoughts in the comments.